watching the latest news from financialmirror.tv. The global financial system could lose $2.8 trillion to the credit crisis, the Bank of England said on Tuesday, before an expected interest rate cut in the United States that others are poised to match. Governments have agreed to inject around $4 trillion into banks and markets to contain the worst financial crisis in 80 years. The BOE is expected to cut interest rates next week, a move the European Central Bank and the US Federal Reserve are also expected to take to try to encourage more spending in economies increasingly fearful of a long, deep recession. The consensus among Fed watchers is for a half-point cut in overnight rates to 1%, the lowest level since June 2004. It's already cut the benchmark federal funds rate to 1.5% from 5.25% over the past 13 months. The Japanese banking system, which largely escaped the fallout from US mortgage defaults last year, had invested in the stock market, and the three largest lenders are looking to replenish capital lost on the bourse. Tokyo banned naked short selling, bringing the move forward by 1 week. Naked short selling allows traders effectively to sell stocks they don't own and without borrowing them first, in the hope they'll profit by buying stocks back at a lower price. The yen pulled away from a 13-year high against the dollar due to growing caution about the possibility of official intervention. European shares recovered on Tuesday to break a 5-day losing streak, helped by sharp gains in heavyweight oil group BP after strong quarterly profits and Germany's Volkswagen. But analysts were wary of hailing the bounce in the broader market as anything other than a brief recovery. The FTSE Euro First 300 index of leading European shares had lost more than 20% in October, hurt by the unfolding credit crisis and the growing fear of global recession. Most miners rose as metals prices in London recovered, bouncing off lows on the back of losses by the dollar before a 2-day meeting of the US Central Bank. London Metal Exchange copper for delivery in 3 months rose more than 4%, having dipped almost 5% earlier. World stocks rose sharply on Tuesday and Wall Street looks set for solid gains as investors indulged in a burst of bargain hunting after 5 straight global trading sessions of steep losses. The day marked a break in the recent trend, which has seen investors battered by crisis and recession worries. The latest has been the need for hedge funds and others to cut their holdings of emerging market assets, to raise cash for redemptions and to reduce the risk of further losses. Hungary's government braced for a possible recession in 2009, and Poland's approved a timetable to adopt the euro on Tuesday as ex-communist Europe struggled to contain the spread of the financial crisis. The head of the IMF urged lawmakers in Kiev to quickly pass legislation to underpin a $16.5 billion rescue package, and other governments across the region scrambled to rework their budgets and take other steps to ward off economic collapse. The fund also said it was not in talks with Romania, a country whose debt was cut to junk status on Monday. Hungary, which like Ukraine and Iceland is tapping the IMF for a loan to shore up its finances, said it would modify its 2009 budget to allow for the risk of recession. Latvia, whose credit rating was also downgraded by S&P, along with neighbouring Lithuania on Monday, said it would cut its 2009 budget deficit further. In Bulgaria, another EU state seen vulnerable due to heavy dependence on foreign borrowing, the government slashed its growth forecast to 4.7% from 6.5% previously. Poland's government approved a euro adoption plan under which, according to Polish media, the largest EU newcomer is envisioned joining the ERM2 waiting room to Eurozone entry early next spring and swapping its zlotys for euros in 2012. Across the Atlantic, General Motors and Cerberus Capital Management have asked the US government for an unprecedented $10 billion rescue package to support a merger between GM and Chrysler. GM has been in talks with Cerberus about buying Chrysler since last month, but the discussions have been snagged by difficulty in securing investment or financing for a deal at a time when credit is tight and global auto sales are in rapid retreat. A decision by the Bush administration to provide the government's first funding for the auto sector since the $1.5 billion bailout of Chrysler in 1980 has been widely seen as the merger's best chance for success. Analysts see GM, Chrysler and rival Ford having been driven to the brink of failure by a combination of management missteps, slowing global growth and problems in credit markets. A combined GM Chrysler would control a third of the US auto market by sales and would face immediate pressure to cut costs stemming from excess capacity in almost every facet of its business. Chrysler's US sales have tumbled 25% this year, almost twice the rate of decline for the overall market. GM sales have dropped almost 18%. With Grand Prix racing reaching its final and crucial race in Brazil this weekend, Ferrari has warned it might leave Formula One if the controversial standard engine option comes into effect in 2010. Despite negative reactions from all manufacturer teams, the motorsport body FIA said on Monday that the drastic cost-cutting measure was moving ahead, prompting the famous Italian marque to say it was considering whether to stay involved in the sport it's supported since 1950. Ferrari's position follows Toyota's strong reaction, with the Japanese team considering a return to Le Mans and prototype racing. All teams have indicated their support for cost reductions in Formula One. Meetings between the FIA and the Teams Association are scheduled to take place in order to look at other options. That's it. Thank you for watching FinancialMirror.tv.